Imagine this. While U.S. investors brace themselves for uncertain office vacancies, falling valuations, and shifting tenant demands, Canada's commercial real estate market is quietly emerging as a beacon of resilience. Surprising as it may sound, recent reports show Canada is not just holding steady, it's outpacing the U.S. and other global counterparts as a more attractive destination for investment capital. For years, Canadian property markets were seen as a slower, steadier cousin to the high-octane U.S. sector. Now that stability is turning into a competitive edge, capturing the attention of institutional investors, pension funds, and global players who are reassessing the North. This shift begs the question, why is Canadian commercial real estate gaining ground at a time when global markets are struggling? The global backdrop: rising uncertainty everywhere else. To understand Canada's relative advantage, we need to zoom out. Globally, commercial real estate is grappling with a perfect storm. High interest rates. Since 2022, central banks have raised borrowing costs, dampening demand for speculative projects. Office space shakeout. Remote and hybrid work models have gutted downtown office demand in cities like New York, San Francisco, and London. Geopolitical and economic tensions, trade disputes, inflationary pressures, and slowing growth in China have added layers of uncertainty. In the U.S., vacancy rates for office towers in some metros exceed 20%, forcing landlords to slash rents or consider conversions. Even retail, once thought to be stabilizing, is under pressure from shifting consumer patterns. Against this backdrop, Canada is standing out, not because it's immune, but because its fundamentals remain less volatile. Canada's secret weapon: stability meets scarcity. Commercial real estate thrives on two things: demand drivers, tenants, businesses, and trade, and supply limitations, what's actually available. Canada currently has both working in its favor. Population growth through immigration. Canada leads the G7 in population growth, fueled primarily by immigration. This translates into higher demand for retail, logistics, and multifamily housing, creating spillover benefits for commercial development. Limited supply of space. Industrial and logistics space, in particular, remains in extremely short supply. Windsor, for example, reports an industrial vacancy rate of just 3.37%, compared to a national average of 5.3%. Toronto and Vancouver are also among North America's most competitive industrial markets. Stable financial system. Canadian banks, long known for conservative lending practices, avoided the kind of over-leveraging that has plagued U.S. regional banks. This means fewer fire sales and distressed assets, and more controlled adjustment to new interest rates, where the growth is happening. 1. Industrial and logistics. This is Canada's golden child right now. E-commerce growth, supply chain reshoring, and infrastructure investment are driving sustained demand. From distribution hubs in the GTA to manufacturing expansions in Ontario and Quebec, industrial space is commanding premium rents. 2. Multifamily and mixed-use development. Canada's housing crisis has become a national priority. With demand far outpacing supply, institutional investors are increasingly turning to apartment buildings and mixed-use complexes that blend residential with retail or office. The new housing project in Montreal's Bridge Bonaventure district is a prime example of public-private collaboration in this space. 3. Retail reinvention. Far from dying, retail in Canada is adapting. Developers are rethinking shopping centers as lifestyle hubs, combining entertainment, dining, and essential services. Billionaire developers like Ruby Liu are even eyeing former Hudson's Bay leases for revitalization projects, showing confidence in the sector's future. 4. Selective office investments. Yes, offices remain risky, but Canada's Class A urban towers, particularly in Toronto and Vancouver, are holding their value better than comparable U.S. cities. Demand is shifting toward energy-efficient, tech-enabled buildings that appeal to hybrid workforces. What sets Canada apart from the U.S.? So why are investors saying Canada is beating out the U.S.? A few reasons stand out. Lower vacancy rates. industrial and multifamily in Canada, are significantly tighter. Government backing, federal and provincial initiatives, from housing accelerators to infrastructure spending, provide tailwinds for long-term growth. Currency advantage. For U.S. and international investors, the weaker Canadian dollar makes assets more affordable. Cultural preference for stability. Canadians tend to avoid speculative booms. That means fewer dramatic highs, but also fewer catastrophic busts. This boring but steady quality is exactly what investors crave in volatile times. Risks to keep in mind. Of course, no market is without challenges. Investors in Canada need to weigh interest rate sensitivity. While banks are stable, high borrowing costs still affect deal flow. Affordability crisis. Housing shortages could create political risks if affordability measures stall development. Regional disparities. Not all provinces are thriving equally. Alberta's energy-linked market looks different from Ontario's tech-driven one. Global slowdown. Spillover. Canada's economy is still linked to U.S. demand. A recession south of the border would ripple north. The bigger picture. Canada as a safe haven. At its core, the reason Canada is gaining ground is trust. Investors trust the legal system, the banking system, the government's commitment to infrastructure, and the long-term demographic story. When compared to markets experiencing political volatility, asset devaluation, or systemic financial stress, Canada shines as a safe, reliable harbor. Even in condos, where prices have dropped to a 4-year low, investors see opportunity. A correction today means an entry point for tomorrow's rebound, especially in cities where demand cannot stay suppressed forever. What this means for investors, developers, and everyday Canadians. For global investors, Canada is back on the map. Pension funds, REITs, and private equity are reassessing portfolios with Canadian allocations. For developers, mixed-use industrial and rental housing projects will remain high-priority bets. For Canadians, expect to see more cranes in urban centers, more adaptive reuse of retail and office spaces, and continued debate about affordability versus growth. Conclusion: the conversation isn't over. Canada's commercial real estate market is not without challenges, but it's clear why the world is paying attention. In a time of global turbulence, Canada's combination of stability, scarcity, and growth potential offers exactly what investors crave. But here's the real question for you. Do you think Canada's steady rise will continue? Or are we simply in the calm before another global storm? Drop your thoughts in the comments, whether you're an investor, a homeowner, or someone watching the cranes from your condo balcony. How do you see Canada's commercial real estate shaping your future?